So you want to be a property investor and you're using appreciation as your end goal. Hi, I'm Aldric Toyad. I'm a real estate negotiator with RGroup Sdn Bhd. My REN number is 32167. Let me just do a quick recap. There are two ways a property investor makes money from real estate. First, appreciation. Second, rental or regular income generated by the property. In this video, I'm going to share with you three, possibly four, risks that you face as a property investor trying to earn that income, using the capital appreciation angle. So the first risk, if you're buying a property that is a newly launched project, okay, the first risk that you face, of course, is the incompletion of a project. Incompletion of a project can happen before the period where you get the property and it is handed over to the respective buyers. The risk is present in any economic cycle, more so when it is in a not so good a bad economic cycle where capital may be tight. Right? Capital may be tight, people are not buying, consumer confidence is lower. The second risk of appreciation is when you're buying low, selling high, you might find a snag, especially if you're flipping the property, right? You might find a snag in your plans because probably, especially in terms of financing, your renovation costs may overrun, your operation period may overrun, it may be delayed in terms of receiving the property as you are trying to transfer one property from the previous owner to yourself. That's the second risk. The third risk that you face when it comes to capital appreciation is the time frame. You know, some people purchased an area outside in the outskirts of, let's say, the Klang Valley, and it took them about a decade or 2 decades, 10, 20 years before they see significant or substantial rise in property appreciation. One, it could be factors affecting this. One, the demand for that area is not as high. Number two, it's still the development is at a slower pace than predicted. Three, perception. Public perception affects demand for that area. Let's put it this way. Once upon a time, staying in Klang and working in Kuala Lumpur or Petaling Jaya felt like a distance. It's so far. Heck, there are memes going online where people staying in Subang Jaya feels KL is so far. Heck, people in PJ feels like KL is far. Right. So that's public perception. And to address the three risks, okay, let me just throw in a fourth risk. A fourth risk is when you have to deal with the lack of maintenance for a particular property. Right? This is especially when you have a common management body, joint management body, where you're hoping to buy low, sell high, but unfortunately, due to mismanagement by previous management companies or bodies, it did not deliver up to par. So therefore, in between, the demand or the deal for that property fell and dwindled. People start talking about it. I'll throw in a fifth one. A fifth risk that you face is by the time you got the property, people aren't buying. Right now, as many real estate negotiators or agents will tell you, real estate professionals and even financial professionals will tell you, the property market in Malaysia is soft. We're going through a buyer's market, meaning more supply than demand, especially in certain areas, right? So in this case, people are holding off big ticket purchases, and you will be stuck with that property for at least 6-12 months until time picks up. The economy, perception towards the economy picks up. The reason I say perception, again, like stock market, like many forms of when it involves people, emotional drivers are the predominant drivers rather than the value itself. We've seen in economic cycles where people make money, people lose money, businesses thrive, businesses fail. So it's not a universal. Times are challenging, yes, but it doesn't mean, it depends on the strategy that they're adapting. Okay, so I'm going to my 5-minute marks. Okay, how do you mitigate the risks? Knowing the risk is one thing. How do you mitigate it? Number one, identify your goal. What is your goal? What is your time frame, your risk appetite, your time horizon, right? I'm speaking to you as an advisor, an investment advisor now, even though technically I'm still a real estate negotiator. This is a general principle for any investing vehicle. What is your time horizon? If your horizon is 5 years, then probably you may need to look at a more hotter markets. If you're looking at a longer period, then you can venture out the likes of, you know, Cyberjaya, Kajang, the likes of City Shah Alam, where there is development, but it's not as hot as in Petaling Jaya, Mont Kiara, Bangsar, Ampang in KL, Jalan Ampang itself, where it's hotter. Okay. And then your risk appetite, of course, how much loss can you take in the event that things doesn't go smooth and well. And the final way to mitigate the risk is, of course, you know, have a group of advisors. I'd be more than happy to help you over coffee, over drinks, you know, to give an input. There are other more experienced real estate agents, real estate negotiators. Call them up. We are here to help you. So again, if you have any other questions related to property, feel free to leave it in the comment section down below. Like, share, and subscribe, please, to the channel, to the page. And thank you very much. You can contact me on my mobile number 019-883-1326, 019-883-1326. Thank you very much. I hope you have a great day ahead. Bye.